What is that one big mistake that you've seen that buyers have made?
Try to keep everything the same when you got pre-approved, right? Don't go out maxing out the credit cards. And for sure, don't quit your job or go self-employed, but that can kill a deal. Late payment is a killer on credit report.
Lenders may not tell you everything that you may need to know, especially when you're ready to get that mortgage as a first-time home buyers or even as a resale. So today we have Jatin Patel on my podcast. We're going to be talking about mortgage and how it works and how you can get qualified and make it an easy process. So let's go ahead and get started. Hi Jatin, welcome.
Thank you for having me.
How are you feeling?
I feel good.
Good. Well, thank you for coming by and talking to my viewers about mortgage and how it works and the ins and outs and maybe the red flags that they might have to be aware on. First of all, tell me, what is your background? How long have you been in the mortgage?
I've been in the mortgage industry for about 13 years now.
13 years.
It all started with me going to a job fair and getting an opportunity to get into this industry.
Oh my goodness. So you know a lot. You've done a lot.
Yeah, I've been around. Yeah, so 13 years. I've done processing, loan officer, and loan officer assistance.
Oh my gosh. Okay. Well, I've got several questions here. I do not want to forget these questions from my clients that had told me to ask you. So I'm going to go through these flashcards and then we're going to just kind of go in the flow. First of all, main thing for clients is getting a pre-approval. What is that and why do you think that's important?
So it's always great for buyers to get pre-approved. That is at least getting an application completed with a lender and let the loan officer check credit, check income, and be able to provide you with the loan estimate so you as a buyer can see the monthly payment for the purchase price you're trying to buy so you can get comfortable with that. And two, you can see all the costs associated with the loan, right? Look at the bottom line of what your cash to close, how much are you going to bring with closing costs, prepaids, and down payment. So that helps you understand and get comfortable and be able to buy that house and not panic.
And then also let them know what they can afford, right?
Correct. It's always good to know how much you can afford. You never want to walk into a house not knowing what you can afford, but you might fall in love with it.
Yes.
And then you might not be able to buy that house.
And the other thing also is important, like yes, you're approved for let's say $600K to purchase that property, but you don't want that buyer to go and purchase it for $600 and max it out. I feel as a monthly payment, they probably don't know there's utilities, there's other costs that they have to factor in, correct?
Correct. So those are the costs that we don't factor in, but those costs are there. It is not just your monthly payment, and it doesn't stop there. There's a lot of cost that goes with owning a home that we don't factor in, that buyer needs to factor in.
Yeah. So very important to get pre-approval before even you go shopping around and finding a house that you cannot afford.
Correct. It's always key to get pre-approved so you know exactly what your max buying power is.
Okay, well that's great. And my next question is how important is for a buyer's credit, a good credit score?
So obviously we know credit, what your credit score is reflects on what your rate is going to be, right? So on conventional loans, we can do credit scores low as 620, but anytime you're ready to buy a house, we want to try to get your scores up as high as we can to get a better interest rate.
So how can they improve that score to get a better interest rate?
Paying down credit cards, right? Many consumers don't realize that anytime you go over 30% of your limit, so for instance, if your limit's $1,000 and you go over $300 and you start charging it up and get over that 300 balance, your credit scores start getting dinged and it keeps going down. Even if you pay off the credit card when it's due, the minute you go over 30%, your scores start getting dinged. So pay off those credit cards and keep the limit below 30%.
And do you advise if there's looking for a home right now, they're pre-approved, they go under contract, what is that one big mistake that you've seen that buyers have made?
Try to keep everything the same when you got pre-approved, right? Don't go out maxing out the credit cards. And for sure, don't quit your job or go self-employed, but that can kill a deal.
Yeah.
But just try to keep the same, right? Even after you get a clear to close and you haven't closed, don't go shopping, because we as lenders, underwriters can still do a soft pull the day of of closing, and if we see that Best Buy pulled your credit over the weekend, we're going to start asking questions. So don't open up any new accounts.
Because you also check it, I'm sure, at the end.
Correct.
And
underwriting can.
Have you seen that happen?
I have, yes. So we got clear to close on Thursday. We weren't closing till Monday. Buyers went out and charged up on a credit a refrigerator. Luckily, they were not tight on DTI, so we were able to add it back on. But that just created a little bit more paperwork on their end. We underwriting did a soft pull, realized that Best Buy had opened up, they had pulled their credit, and then we started asking questions. Now we realized they bought a refrigerator on a credit.
Oh my gosh! And I know you said DTI. What do you mean by DTI?
So DTI is debt to income ratio. So whenever a buyer wants to get pre-approved and the lender talks about DTI, that is debt to income ratio. So whatever your monthly gross income is, let's just say $10,000, we can only use 50% of that. So out of that $10,000, I can only use $5,000. With that $5,000, I have to budget all your liabilities, monthly liabilities that's on your credit report, plus the new payment for the new house that you're trying to buy. And all of that has to stay below $5,000. So that's what DTI stands for, debt to income ratio.
That's good to know. A lot of people don't know what DTI means.
Correct. A lot of consumers think that we're counting the full, they make $10,000 a month, therefore we're counting the full $10,000 a month, but we only count half. This is where the other expense comes in with the other half that we're not factoring into our debt to income ratio.
So which is also safer for the buyers because you're pre-approving them on the 50%.
Correct.
The remaining they still have.
They have other liabilities that they have to fulfill. Yes.
Okay, at least that's a safety for buyers, I feel, in a way.
Yes.
And then another question that my buyers do ask is, hey, we are ready to buy a house and we want to get the best rates and everything is like a deal. We want to get a really good deal on the mortgage, the rates. How many can we shop around and how long can they do that for?
Yeah, so they can shop around. From the first mortgage pull, you have 2 weeks to do as many pulls as you want without it affecting your credit score.
Many is like what? What do you say?
As many as you want. Okay.
There's no need.
Rates are based off market, right? So you're not going to get 3% at one place and 6% at another place, right? It's going to be an eighth to a quarter difference, right? So now a mortgage company doesn't control the rates; they're based off of a market, right? So. But there's more to it than just rate. You want to also understand customer service. Are they local? Are they online? There's a lot that goes into choosing the right lender. I know rate is a big factor, but there are more keys that you also want to pay attention to.
What are those keys?
Again, are they online? How easy can you get a hold of your loan officer, right?
Yes.
Because in our role, we want everything to go perfect.
Yeah.
But now you're 2 days before closing or you're 1 day before closing and we don't have the clear to close and you've already got the moving truck ready to go.
Yes.
That's when it really counts.
Yes.
Is your loan officer or is your lender going to pick up that phone and do whatever it takes to get you to the closing table on the day you're supposed to close?
And I think it's very important. The communication is the key factor for anybody that's trying to choose a lender. Are they available and are they ready to pick up that phone call in an emergency situation to answer those questions at the tough times?
100% agree. So this is probably one of the biggest purchase buyers make, right? And more than anything, they're just looking for communication.
Yeah.
They want to be able to know two things. A, that they're going to be able to close on the house and they're going to close on time.
Yeah.
Right. And sometimes stuff happens, but as long as it's communicated and buyers know that you've got a plan in place, ready to go, that's all they're looking for. They don't want to go to sleep not knowing where they stand.
Yeah.
Right. And that's one of the things that, communication is important just to keep everybody on the same page.
That's totally true. But then when they're also shopping around for rates, another question is, does it affect the credit score?
No, because you have that 2 weeks, right? So if you do your first pull, then you have 2 weeks to do as many pulls as you want without it affecting your credit score.
Okay.
So they're a little bit more lenient on the mortgage pull than they are on car pulls or stuff like that.
Okay, well that's good to know. Another next question is, what is a key differences between getting a loan from a new construction versus a resale? Because I know you do both.
I do. I do new construction and resale. New construction gives buyers a little bit more incentives from the sellers to then be able to reduce the interest rate or cover that towards closing costs and prepaid. So then they're only just bringing their down payment. Sellers can do the same thing too, but it's kind of hard for a seller to kind of fork out, 6% of the sales price towards incentives. So it's just to make it a little bit easier for buyers to be able to offer incentives
through the new construction builder, especially they're connected with them.
Yes.
Okay. And do you think, well, I guess it's up to the buyers to kind of see if they want to go with the new constructions versus an outside lender, that communication would still play a key factor in that, right?
Correct. So builders have preferred lenders for a reason because they've worked with them in the past. They like how they operate. They've got a little bit more control as far as communication and all that goes. So that's why they offer incentives for using their preferred lenders, because they know that they're going to close on time. Not to say the other lender is not going to, but they've got easy access to be able to pick up the phone and call them and get somebody on the other line to answer questions.
Okay. Yeah, because right now a lot of the buyers are wondering, new construction, yes, they have a full-blown package. They're giving the great rates, 30-year fixed rates, with a lot of the other incentives. Closing costs are fixed in there. They're paying for the closing costs. So the only benefit I kind of see if they go with the outside lender versus a new construction lender, it's probably the communication relationship that they had, or I don't know if the rate, because they're already getting a good rate.
Yeah, so there's really not a benefit, right, with the incentives. Like, so it's, at the end of the day, when you compare apples to apples, you're going to get a better deal with the preferred lender from the builder because of the incentives, right? And obviously, incentives are tied to you using their lender, right? If you use somebody else, you don't get those incentives. And so whenever you look at loan estimates from both preferred lender or an outside lender, you'll come to see that it is a better option to go with the preferred lender with the incentives. That was going to give you the best deal, the best rate, keep more money in your pocket when it comes to cash to close, because you can use those seller credits towards closing costs and prepaids.
Yeah. Okay. Good to know. And what is the most damaging mistake a buyer can make when working with a lender?
Outside of quitting your job, it's, again, opening up a new account, right? In the mortgage industry, everything has to be checked, rechecked, and double checked. Yeah. And underwriters have, I don't know how, but they have ways to find out everything. So, so just. I think the biggest fear for a lot of us, even the realtors, is the underwriters. Well, so like, whenever you say underwriting, we feel like it's somebody in the dark room just ready to. You're imagining. We're lenders. We're not here to deny loans. Yeah. We want to approve loans. We want to get you approved, and we want to get you into your dream home. But there's just rules and regulations that we have to follow, and so it's just to make sure that you are able to fill this loan and you're able to pay it back, right? So they're not all that bad. They're nice people. And what exactly is an underwriter for someone that's new, that doesn't know you're a lender, but who's an underwriter? So underwriter is the person who follows the guidelines, right? Looks at the file kind of with a fine comb, make sure everything's in line within guidelines to be able to get an approval, right? Underwriting's job is to look at the file and feel comfortable knowing that the buyer's going to be able to make the payments and not put a buyer in a bad situation where it's going to be hard for them to pay back, pay their monthly payment and then have to foreclose. So that's an underwriter's job. Yeah. And so another question that I have is, let's say they're ready to apply for a loan. What are the quick steps that you can tell to go smoothly? So again, if you're about a couple months away, 2-3 months away of, okay, we're going to get started looking at homes, get those credit card balances down, right? And keep them down. Where can they check? Can they check somewhere for the credit scores? So like all the consumers, like Credit Karma, I think most of the banks also give you access to be able to check your credit. That's a great tool. So a consumer pool like that's a great tool for consumers to keep monitoring their credit, right? Yeah. What the score they see on that is not going to be the same score they see that we as lenders see when we do a lender pool. There's on a lending pool, there's a lot more factors that are calculated into what the score is. Okay. On the consumer pool, they're just touching the top layer. That is a good tool for consumers to monitor their credit, make sure no new accounts are open without their knowledge, and just kind of keep track of what their balance and everything is. On the lending side, that's when that going over 30% of your credit card, that's when that score factors into on the lending side. So it's two different scores, but that is a great tool for consumers to keep an eye on their credit and make sure there's nothing going on in there.
And you're saying that's not the actual score that they may see on the consumer side. Do you know what like the difference might be?
There's not really a set number.
Okay.
I've seen it. Like whenever I tell buyers your score is this, they'll send me a screenshot of what it is on there, and
no,
typically
it's 800.
Yeah, and it's typically about anywhere from 20 to 40 point difference.
Okay.
So
below. Probably.
Below, yeah. It's usually always low on the lending side. The lending pool score is always going to be lower than what the consumer is for the most part.
Okay, so always expect a little bit below than what you're seeing on your consumer side.
Correct, but as a consumer, understand what score you see there is not the one we're going to see, and it's not the one we're going to go off of. We have to go off of what we see when we do a credit.
Which only you guys see.
No, as a buyer, once we pull credit, you have access to the credit report. If you request a credit report, we have to give you a copy of that credit report.
Okay.
And it's always good to get it, so that way, you can check, make sure all the accounts are your accounts, and just make sure there's nothing going on. I've seen times where buyers do the credit cards where it automatic renews, and they forget about it, and now there's a late payment because they're not using that credit card, but they didn't realize that there's a yearly charge, and they forgot to pay it now because they thought they didn't have to pay it because they haven't used it in 2 years.
Oh my gosh.
So it's always good to get a copy and look at all the accounts.
So late payments, do not do any late payments.
Late payment is a killer on credit report. It drops your scores down significantly.
Is it only once they report it though?
But it's hard to get it back up though. It really takes
It doesn't have to be reported as long as it shows late. It still dings.
With credit card companies, they usually don't report it unless it's over 30 days late.
Okay.
Right. So if your payment's due on October 15th, and now we're getting to November 15th, and now you need make another payment, but you haven't made that payment, that's when they'll report it.
I see.
Typically, if you get it in within that first month, I'm not saying you need to do that every time, but do just a one-off. If you are late and it's a couple days late, it's not going to ding your credit score report that it's late. They won't report it unless it's 30 days or more.
Got it. Okay, so keep your credit
payment. It's always good to make those payments on time. Like I said, a late payment. Once a late payment goes on your credit report,
then it's
going to drop your score significantly.
Oh gosh.
And then it takes a while to get it back up.
Okay. Another question that I've been being asked by the clients is mortgage rates. Because the way the market is right now, where can they track mortgage rates daily? Is there somewhere that you recommend? Yeah,
there's so many websites out there. They can just Google track mortgage rates, and it won't tell, it's not going to show you this is what the rate. They'll show you the chart of what the rates are doing. So they're out there.
Okay, so you don't have a specific
I don't.
one. Okay. Yeah. Now the other questions I have is, what are some of the things that we talked about that one, but what happens if a buyer's financial situation changes? Did we talk about that in the loan process?
No, it's always good to let your lender know, right? I always tell my buyers, hey, if that job, your dream job, happens to fall on your lap and you want to take it, just run it by me first, right? Let's make sure income checks out, make sure your DTI is still in line. If it's more money, then great. That DTI is going to go lower. If it's less money, then you want to check with your lender just to make sure we don't go over the limit on DTI. And especially if you're W-2 base salary, you don't go into commission, right? Because commission, you need 2-year history of receiving commission for us to be able to take the average, right? So you don't want to make that switch from W-2 income to commission, because then it's going to affect your approval, because now we don't have income to work with because you don't have a 2-year history of receiving commission.
Okay.
So, but always check with your lender before you make that move.
Yeah, because I have another one that's under contract with new construction. Sometimes new constructions may take 6 to 8 months for the building to go and close. And she's like, can I change a job right now? Probably make sure with the lender before you do any kind of major decisions, right?
Correct. If it's a base salary, if your current job is a base salary and you're switching to a base salary again, like, hey, it's W-2 income base salary. I get 125 now. I'm making the move. I'm going to get 150 base salary. That is fine.
Okay.
Right. That lenders can accommodate that. All right. We don't need to wait till after you close.
So you always need 2-year income.
For commission, bonus,
For bonus income.
and overtime, and hourly.
What if they just started a new job? Like they don't have any history of work.
It depends on if what was the reasoning why they were out of work.
Like a fresh student, let's say that.
That's totally fine because
Okay.
they were in college.
Okay.
And then we need a 2-year history of employment, but we would offset that with a transcript to say they just graduated and now they're getting into the workforce. So that's totally fine.
Okay.
If there's a long gap of just whatever it may be, that sometimes people take off to take care of a family member, and there's a year gap. That's fine as long as we can document there was a reason of why there's a extended gap period unemployment.
Okay. Now the other question that we get a lot is the appraisals, right? Let's say, hey, I made an offer for $500K and my appraisal came in low. What happens?
So this is when you want a good realtor on your side, right? First step is to always have your realtor get with the listing agent's realtor to see if you guys can negotiate, right? Obviously the appraisal came in low, to see if there's any wiggle room to adjust the sales price. Mm-hmm. If there's not, buyers can still close on a house. It all depends on down payment, right? So they have to at least have, on a conventional loan, 5% down. In some cases, first-time home buyers, 3% down. So they have to at least have that. So there's still options for buyers to be able to figure out how to make it work if the seller is adamant about not lowering the sales price. But the first step is to always go back to the agent to see if there's a way to figure this out.
Or also have to come up with the cash.
They will have to come up with the cash as down payment, or if they're already putting 20% down, they can still keep that 20% down, but the LTV is going to change a little bit. So then now they might have mortgage insurance, but still be able to just bring the same amount for the down payment.
Okay. And LTV, can you explain? Loan
to value.
Loan to
right?
value.
So what is the value to the loan, right? So if you're putting 20% down, then you're going to have 80% LTV.
Okay. And then you talked about first-time home buyers. Is there any special program or loans offered for Texas, if you know?
Yeah, there's, down payment assistance is usually the most popular one when it comes to first-time home buyers, for buyers who are right out of college, or, they just need a little bit of help for the down payment. So there's programs that will help with the down payment assistance.
Okay. And what about like healthcare heroes?
Yeah, so there are programs out there. It's almost just the same thing with the down payment assistance
Yes.
program, right? With teachers, firefighters, and all that. So it helps with the down payment.
Okay. And then do you guys offer those for your...
We do, yes.
Okay.
So we do. We have different entities that will help with the down payment assistance.
Okay. Now, one of my very question right now with the way the market is, we have lots of homes available. The sellers are hesitant. They're like really wanting to sell their home, looking for options. How can a lender help with that for helping with them selling the property?
So just the way, if seller is willing to, give buyer incentive, like closing costs incentives, then as a lender, we can help reduce that interest rate to help the buyer keep their monthly payment manageable, right? There's a 2-1 buy down program, or we can use the seller credits to buy the rate down below par to help keep their payment lower.
Okay, so but the seller would have to pay extra for that, right?
They would have to give credit, just like
Credit,
giving
yeah.
credit, to the buyer to help reduce the rate.
Okay. Okay. Well, now we have our rapid fire questions. I've got 5 questions for you. Number 1, what's the biggest mistake home buyers make when choosing a lender?
Just going off of the interest rate.
Okay. What's the ideal credit score getting the best mortgage rates?
780 or higher.
Biggest mistakes buyers make during the loan process?
Not telling us about bank statements that they move money around.
Top tip for first-time home buyer.
Get comfortable with a monthly payment.
And if the interest rate drop after closing, what's the best strategy for refinancing?
It's have a goal in mind of what you want your monthly payment to be and then refinance.
And who can they go with?
They can go with their lender or reach out to me.
Okay. Well, that's it for our podcast today. Thank you, Jatin, for coming and talking to us about mortgage.
Thank you. It was a pleasure.
And if anybody wants to get more information on a Mission Mortgage, I've got some information on the link below. Let us know. Thanks for watching, and we will see you next time.